Good morning, everyone. Welcome to Councillor Buchanan and Mitchell's year-end tax planning and market update. We are very happy that you are here to join us as we cover what's been going on in markets, kind of give you our outlook for the next year, as well as cover there's been a lot of changes in taxes, and so there's a lot to cover there as well, and some important things to think about as you're planning for the year ahead. By way of introduction, my name is Greg Estes. I am the Chief Investment Officer of CBM's Wealth Management Group, MBI. And I will be joined by Richard Morris, who is our Executive Vice President and Director of Tax Services. Richard, if you flip the slide, you'll see our beautiful faces. Richard is our tax guru, or as you might want to think of him, our tax whisperer. So he's going to be giving a lot of thoughts on what's been going on this year, and then what you should think about going into 2026. So from my end, as we hop to the next slide, I do want to cover a market review, and just to get us in the spirit of the season. Yeah, I'm sure many investors feel like they've been good little boys and girls this year, and they're asking Santa Claus for the same thing they ask for every year. Or in this case, maybe not Santa Claus, but Uncle Jerome Powell, and that is more rate cuts. The market loves when the Fed cuts rates. The Fed is meeting as we speak, and they will be coming out with their rate decision. Incidentally, if we were to look at the Fed funds future markets, we would see that there's about a 90% probability that they cut by 1/4% today. But that remains to be seen. We will see, once they wrap up the meeting. On the next slide, just kind of giving you an outline of how I'm going to approach this review. The first big topic is kind of the economy. And, there's growth in the economy as a whole, that gross domestic product growth. The jobs market, how is that doing? And the inflation picture. All of these data points are used by the Federal Reserve to figure out what their monetary policy stance is going to be, and whether they cut rates, whether they keep them steady. And that in turn feeds capital markets. So what's going on with capital markets, and maybe what should we think of as far as capital markets are concerned going forward? So without further ado, on the next slide, let's just start with the economy itself. What a difference a few months make. If we go back to the first quarter of the year, when the administration was talking a lot about tariffs, and tariffs are really dominated this year, that shock of these big tariff announcements caused a lot of concern among economists, among investors, about what is the economy going to go into recession? And some economists started to increase their probabilities of recession chance earlier in the year. Well, all of those probabilities have now faded back. As I'll show you on the next slide, the estimate for the third quarter, now the third quarter ended September 30th, but the estimate of growth for the third quarter versus the third quarter of the prior year appears to be pretty strong. This chart is showing you a couple of different kind of reads on how the economy's been growing. The blue chip consensus, these are economists, and so it's kind of got a shaded range, somewhere between 1.5% to over 3% growth in the economy, which is fairly strong. But if you look at that green line, that's the Atlanta Federal Reserve's own measure, which is the GDP Now estimate for how much the economy grew in the third quarter. And that's touching on 4%. So it would appear as a whole, the economy is doing rather well. Consumer spending is still strong. Corporate investment is still strong. So these are good signs that the economy isn't slowing down, that it's not moving in the wrong direction. Now, with that said, the next slide gives you an idea that the labor market is getting softer. So what we are looking at is the unemployment rate in light blue, which is kind of the official measure produced by the Department of Labor. And you can see that that's been sliding up a bit since 2023. The dark line is the Chicago Federal Reserve. So again, one of these regional Federal Reserve branches, they kind of produce their own estimates of what they think the unemployment rate is. And again, that's also creeping up. They think it's touching around 4.5%. If we were to look at this over many decades, that's not very high. That's actually still pretty low, but you can see it's been moving up from where we were after the economy reopened, coming out of COVID. So, the labor market isn't awful, but it is slowing down, and there are fewer job openings than there had been in the past. The next slide kind of gives you a really good sense of a couple of data series about the job market. That blue line, that's the Challenger series. These are announced job layoffs. So if you read the paper, I think all of us do, these are those headline, Google announces this layoff or UPS announces that layoff. So that's kind of aggregating those headlines that you see, and you can see how much it spikes at times, and it spiked certainly earlier in 2025, as some of these companies decided they were going to dial back hiring or even lay people off, given the uncertainty with tariffs. You can see it spiking again in more recent history, and yet if you look at those unemployment claims in red, they're still rather low. So I guess the point here is sometimes we internalize what we read in the paper, these headline things, but the data from the unemployment claims, initial unemployment claims, doesn't really show some kind of major spike. So that tells me the job market is indeed slowing down. We're getting more layoffs. There are jobs being created. But if you're out of a job, it's going to take longer to find a new job. So that the labor market is slowing down. So that's kind of what's going on in the jobs market. As far as inflation is concerned, on the next slide, I don't think you need me to tell you when you go to the grocery store that things are more expensive than they had been in the past. Now, I know when it comes to the economists, the Federal Reserve, they tend to look at inflation that doesn't include food and energy, what we call core inflation. But, for everyone else, we do, as a matter of fact, feel those price increases on food. Just since I brought up tariffs, looking at the next slide, the effective tariff rate, and this is going way back in U.S. history, you can see where that effective tariff rate has been over a number of years. Going back to the 80s, the tariff rate has been very low in the US, and we appear to be under a much different regime now with this administration. The tariff rate, I'd say, just to be, cover my bases, somewhere between 10 to 15%. Certainly, that's not as high as some of those shock numbers that we saw when Liberation Day came and the announcement of, 40% for this country, 30% for that country. But it is higher than it had been for many decades. And that throws a lot of confusion into the mix for investors and for just the general public as far as, how much are things going to cost going forward. The next slide, this is just something I thought was interesting. Again, food prices have been impacted by tariffs. There are three different categories here: bananas, ground beef, roast coffee, which is near and dear to my heart, which have shown very significant price increases over the last 12 months. What's interesting about these three categories, now, we certainly do have cattle in the US, but there's a big market for cattle that's raised outside the US, and yet we had tariffs in place that impacted the prices of these three categories of foods. And in the case of banana and coffee, we don't even produce that in the US. So Those tariffs have been pulled back somewhat. It would have been better had they not even been in place the whole time. But it just gives you a sense for, how tariffs can impact regular people, especially when you hit the grocery store. Um, Looking at it from a bigger picture, if you look at the next slide, this is showing you, again, I mentioned that core inflation. So this dark blue line is core personal consumption expenditures. PCE is one measure of inflation. It's made by the Department of Commerce. You can see it's kind of closer to 3%. I think the Fed would prefer, and most economists would prefer long-term inflation to be somewhere around 2%. So it's hovering higher than we would like. But this dotted line is kind of giving you an idea, and this is not food and energy. This is everything else outside of food and energy, that without that tariff shock, readings would have been lower. And the reason that's a big deal is the Fed sets rate policy balancing two big things: employment and inflation. And if they set the rate too low, that can spur inflation. So they want inflation to come down naturally. But if they have the rate too high, that can hurt the labor market. So they want rates lower so they can help with jobs. So if the job market is slowing, they would like to lower the rate. But if inflation is remaining stubbornly high, it kind of adds tension to that rate cut decision. If we didn't have these tariffs in place, I think it would make the Fed's decision a lot easier as far as what to do with respect to rates. The next slide, I just think is interesting because it's inflation expectations. Starting from the beginning of the year, you can see how they moved up, particularly with the announcement of tariffs. People expected higher inflation because of the tariffs. That makes a lot of sense. Well, those inflation expectations have finally started to moderate. These tariffs have been in place for a while, and some of them are being pulled off. And we have, a Supreme Court case which will determine, settling sometime at the beginning of the year, whether the executive branch has the power to just implement tariffs without Congress's approval, or whether it does not. So that the expectations for inflation have started to finally come back down. This is important because these expectations kind of become a self-fulfilling prophecy. If you think inflation is going to be high as a consumer, you might behave one way. If you think it's going to be lower, you might behave a different way. So it's sort of a self-fulfilling prophecy. Okay, capital markets on the next slide. Let's just talk about what's been going on in the stock market and the bond market. Early April, we were definitely headed for, there was a lot of bearish sentiment, a lot of negativity, a lot of uncertainty with tariffs and what that would do for earnings. It's been quite a different market since the summer. So it's returned to kind of that bull market mode that we've been in for a number of years. If you check out my next slide, you can see different indexes, how they've performed this year. So, starting at the left, that's the beginning of the year, running all the way through basically this week, this Monday, how these different indexes have performed. So this is on a total return basis. So you can see that the highest performing subset of the market, that purple line, is the All Country World Index, excluding the US. So everything outside the US. The international investing is having its moment. Bear in mind, this is looking at things from a US investor's perspective. So if you're investing in foreign securities as a US investor, essentially you're buying foreign currency when you own a stock in another currency, and then it's being translated back into dollars. I bring that up because the dollar has gotten weaker this year. So if the dollar's gotten weaker and you own yen or pounds or euros and it gets translated back into dollars that have gotten weaker, you have more dollars. So that's helped the total return from a US investor's perspective. The next index in the rank is the Russell 1000, which is in blue, kind of in that high teens percentage, and then followed by small and mid cap stocks, which have been laggards, starting to pick up towards the end of the year this year, but nonetheless showing lower returns than large cap US stocks. Kind of looking at this from a different angle on the next slide, we've got the Magnificent Seven versus the other 493. It's technically a little bit more than 493, but we'll just call it the S&P 500 because that's what everyone calls it. So the Magnificent Seven total return, that's in this greenish color. And then, the S&P 500 as a whole in blue, and then everything that isn't Magnificent Seven in red. So all the rest of the 493 stocks. You can see the Magnificent Seven has had a better run this year, although if you look back in April, look what was leading the sell-off. It was those big companies. I would characterize this as when we hit periods of volatility, the things that are more expensive tend to sell off first. That's kind of a big takeaway from this. So if we're hitting patches of volatility, you should expect growthier names that are more expensive, that have done well, but are more expensive to maybe be more at risk from periods of volatility. It's an important thing to keep in the back of your mind. Looking at things on the next slide from a really long-term picture, this is showing you returns in the S&P 500 going all the way back to 1980 on a calendar year basis. So those gray bars represent the total return for each year in the S&P 500. And you can see that most of those gray bars are positive. So if you're a long-term investor, you end up with pretty good results. However, you see these little red dots. These are market pullbacks during the year, the same calendar year periods. And what you see is it's not a smooth ride, right? Every year, if you look at it from year in and year out, like this chart's showing you, you can see that over time, if you stay in the markets, it's done very well for you, but there are going to be periods of time during the year when the market pulls back. This is just the way that stocks work. There's a lot of uncertainty there. There are a number of different factors that go into whether earnings are growing or they're flat or maybe they're receding. And the market's trying to weigh those potential outcomes. And in the short term, there's that expression, I believe it's a Warren Buffett expression. In the short term, the market is a voting machine. In the long term, it's a weighing machine. I think that's very true here. Sometimes people get caught up in sentiment, which can lead to, a sell-off turning into a bigger sell-off. And we certainly saw that at the beginning of this year. But, if you have long-term capital that you're not needing for the near future, the stock market's generally been a very lucrative place to put that money. Switching gears to how have earnings been for the third quarter? They've been pretty good. So the way to look at this chart, this is showing you the 4 calendar quarters of 2025. And 2 of those calendar quarters are in the books. The Q1 in blue, Q2 in red, over and done with. What you can see for each of these lines is that they've kind of sloped down. That's no surprise. With the announcement of the tariffs earlier in the year, there was a lot of uncertainty about how that would impact earnings, and the expectations were it would negatively impact earnings. So these lines slope down because those earnings haven't been reported yet, but the expectations for growth starts to recede versus the prior year period. But then you see these big upturns. That's actual results being reported. So Q1, the way to read this, it reported better than expected. Q2 reported better than expected. And we're seeing that again. Most of quarter 3 is done with now. Those reported results were better than expected. We will see if this trend continues with Q4, but it looks like that will be the case. And if we look at it on the next slide on a more calendar year basis, each of these blue lines represents a year. So going back to 2023, then 24, 25, and 26, you can see that 2026 is sitting well above 2025. That would indicate that calendar year 26 earnings are expected to be higher. There's going to be growth versus 2025. And that red line is looking just ahead on a constant basis at the next 12 months. So you can see that that's been moving up So that shows growth. Okay, just a couple of slides. The next slide is showing you how the 10-year Treasury has been behaving over the last few years with some important milestones in there. And what you can see is if you look at 2025, there's been a lot of bounce, right? Because we've had these big announcements on tariffs, and that's caused a lot of turmoil, essentially. And you can see where Liberation Day, when that happened, and the 10-year Treasury kind of plummeting, that's primarily concern about recession, so the rate pulling back like that quickly, and then bouncing back once Liberation Day was postponed, and then kind of gyrating around. But the general trend, as things have gotten a little bit more stable, is for rates to start moving down. This is natural because we had a cycle where rates were going up in 2022, and now, with rate cuts, the general trend is for rates to move down. The next slide is showing you not just the 10-year yield, but now we're looking at the 2-year Treasury yield, the 30-year mortgage rate in green, and then high yield corporate bond yields in purple. And you can see if you look kind of just in the 2020, 24, 25 period, those rates have been kind of moving down, generally speaking. So the reason I mention this is if you have fixed income in your portfolio, the smart play in 2022 was to be really short term in maturity because rates were moving up and you didn't want to get hurt. You wanted to just participate as rates moved up by having short, money markets or T-bills. Well, now that rates are moving down, it makes more sense to have longer term maturities in your portfolio because of the inverse relationship between bond prices and yields. So when yields are coming down, bond prices go up. And if you're longer in maturity, those bond prices go up a little bit more. So it makes sense to have a little bit more maturity or duration, as we call it, in your fixed income portfolio. Just one more topic. It's my bonus round because I do get asked this sometimes, and it's really about how the Fed is set up because there are people that are worried about the administration's capability of stacking the vote, if you will, in the Federal Reserve. And what I would tell you is based on this slide, it's really hard for that to happen. So there are 12 members that vote on rate policy. It isn't just Jay Powell. So the chair, the one highlighted in red, that's Jay Powell. Then there are 6 other governors along with him. Now those 7 governors are appointed by the president and approved by the Senate, but they serve 14-year terms. So it's not like you can just easily replace them. Then there's the New York Fed president, who's the kind of like the primary regional Fed. And then 4 of 12 other regional reserve bank presidents, and none of those are picked by the president himself. These regional Fed presidents are kind of selected by those regional Feds. So that's the voting constituency. If you look at the next slide, it gives you an idea of the timeline of these folks. So Jay Powell's term as chair is coming to an end. Technically, his full term as just a member of the board of governors doesn't end till close to the end of Trump's term. Once he is effectively finishing his period as chairman, he could stay on. It's typically been tradition that the Fed chair leaves. So, Trump's already looking at a successor to Jerome Powell. But if you look at these other timelines, only Kugler, who resigned, has Trump been able to replace. So he's unlikely to replace any of these other governors. I know there's been a brouhaha with Cook. That doesn't look like it's going anywhere. That's another gaggle of people that he can't simply replace. And he can't replace those Fed regional presidents. So a lot of this concern about Fed independence, in my view, is a bit overstated. Okay, so that's the end of the bonus round. And with that, without further ado, I'd like to turn it over to Richard, who's going to talk about all things tax. Take it away, Richard.
Thank you, Greg. That's great perspective. And I know one of the takeaways is always don't overreact. Don't overreact to be it the Fed, be it the market. So as we wrap up 25, it's important to take a closer look at your overall tax and financial plans, as this year might have brought some challenges and disruptions that impacted your personal financial situation, including elections. Marvin Gaye famously sang, what's going on? And now we have some certainty. We know what's going on. And so we don't have to worry about chasing the fluff, as it were. So you may have heard there was one big, beautiful bill that passed this year, the One Big Beautiful Bill Act. Some people refer to it as OB3. Officially, it's been renamed. But just like the Affordable Care Act is always referred to as Obamacare, that's not going to change. So a big takeaway is a lot of stasis. It's things that, as we've known them since 2017, carry forward. But there are some changes that might catch us off guard. So we're going to talk about them. And this is just a lot of the different provisions on there. While we say a lot carries forward, it was a pretty dramatic rewriting of the overall income tax laws as we knew them back in 2017, which seems like a long time ago at this point. So that's the basic order that we're going to go through them. And we'll talk with the individuals and then get into business side and then retirement assets as well. One of the terms we're hearing for all of last year was the sunsetting. This law is going to sunset. And that's just a congressional provision from the way they passed it. It was passed in 2017. And to make the budget numbers work, such as they did, these had to expire at the end of 2025 and revert back to the 2016 rates, which not everybody remembers. Those were substantially higher. So that was the concern, was that there was going to be this sunsetting. We were going to revert back to the old days. So essentially the rates as you've known them since 2017 carry forward unchanged, unabated. There's 7 brackets. There used to be more. We've whacked off the 39% bracket. The 10 and the 12% got added at that point. So you'll notice in this one of the big changes was for single and married filing separate. They follow the same pattern until you get to the 35 and the 37% brackets. So the top 1%, which is adjusted gross incomes over 663,000, earn 22% of all income and pay 40% of all the taxes. Not a political statement, just a fun fact at your next slow party. Dividends and capital gains rates. These are essentially unchanged except for some inflation adjustments. And you see the different brackets you fall into. The 0% is an interesting thing because if your income is below, let's say for single, up to 48,350, you pay 0% on your capital gains. So there are planning opportunities here for this. So if you have a year where you have some unusual opportunities, this is a good one to keep in mind. I will throw one state piece in here, in that the state of Maryland this past summer passed an increase in capital gains rate for Maryland residents retroactive to January 1. So yes, they passed in July, something retroactive to January 1, which was a separate Maryland 2% capital gains tax on top of your regular Maryland tax for incomes over 350, regardless of your filing status. I mean, there are some exemptions in there, home sales, livestock, some other things, but keep in mind that one for all you Maryland residents. Something else that survived unscathed because it was pre-2017 Act. This goes back to the Affordable Care Act in 2013, which is the net investment income tax. And this is another separate tax. You pay your regular income tax. Some may remember when there was an alternative minimum tax, which was calculated separately from your income tax. Well, then what was added on was an investment tax, a tax on your investments. We already tax wages, we already tax gains. Well, this was an additional tax, and these haven't adjusted with inflation. So these numbers in 2023 and 2013 may have looked robust. Now, not just for inflation, they might be hitting way more people than they would have been. And this is what it is: interest, dividends, capital gains. If you happen to have real estate activity that's considered passive, it's subject to this tax as well. So that's sort of a stealth tax that some people may not be aware of until it hits. 2017 added a term to the lexicon called the SALT tax. We never talked about SALT before, but it's the acronym for state and local taxes. And prior to the 2017 Act, this was one of the deductions people gave up in exchange for the lower rates. Prior to the 2017 Act, you could deduct as an itemized deduction all your state and local income taxes. So, I mean, if it was $100,000 of your state income taxes and $35,000 of your local real estate taxes, your property taxes, you got that whole deduction for itemized as an itemized deduction, reduced your taxable income dollar for dollar. However, remember the alternative minimum tax, the AMT. Nobody's really talked about that in a number of years because those same state taxes that you were getting that deduction for were added back. So you had a lot of cases where your $135,000 deduction, in my example, really wasn't worth that because the AMT added it back. So what this does, 2017, it capped it at $10,000. This raises it to $40,000 if you fit in these phase out ranges. So there is some relief there. And that was just horse trading with New Jersey, New York, Maryland, California sort of driving that bus for that. But it does not affect pass-through entities, which we'll get to in a minute. Standard deduction. Again, this is stasis. This is permanently sets the standard deduction and eliminates the personal exemptions as we knew them for federal taxes. No more personal exemptions. What it does have is it's a boost for seniors. So seniors, those over 65, get an additional $6,000. Again, well, this one sunsets, set sunset in 2028. So this is an additional provision in there for seniors. Mortgage interest. This carries forward as we've known it since 2017. $750,000 of acquisition indebtedness. You can deduct the interest from that. You can't deduct the interest on your home equity loan unless it is made to improve the property. So no longer using it to fund vacations, cars, those things. But still, you're adding on that kitchen, whatever, then the home equity is deductible as mortgage interest. No, now we're getting to the political part. No tax on cars. It's really not no tax, but it's a deduction. So this is to promote the American car industry. Your new car dealer will happily provide you support for what qualifies. You do have to provide the VIN, the vehicle identification number, and it can be up to $10,000. So there is that. Again, this one sunsets. So we do see the sunsetting because it's passed under a similar, this act, the one big beautiful bill was passed similar to 2017, and that it is parts of it are going to sunset, but parts of it are permanent. So the home mortgage we talked about, permanent. The SALT deduct, permanent. Charitable contributions. This is the one that may catch some people off guard and probably the biggest new individual provision starting in 26. So 25, the world as we know it for charitable deductions, percentage of your adjusted gross income. In 26, there's going to be, well, two things. One is you'll get a charitable deduction even if we don't itemize. But even bigger, there's going to be a haircut. There's going to be a reduction. So it is similar to medical expenses. So to deduct unreimbursed medical expenses, they have to be over a certain percentage of your adjusted gross income. What's the percentage? 7.5%. How'd we get there? We didn't have time for that. But to the extent your unreimbursed medical expenses are under 7.5% of your adjusted gross income, you don't get to deduct them. For charitable contributions, it's going to be those under 0.5% of your adjusted gross income. So if you're thinking, man, I have this big charitable deduction I want to make this year or next, you probably want to make it this year. Okay. And even if it's above the limits, the excess will carry over. But there is no haircut in 25. But starting in 26, there will be. And this is a provision that didn't really get a lot of coverage because people were more caught up in some other aspects of it. The child tax credit, depending on, these carry on pretty much unchanged dollar-wise, but the twist is that 1,700 of this now 2,200 child tax credit is refundable. And what's a refundable credit? Refundable credit is essentially the government it's as they're giving you money. It's as if they paid in withholding on your behalf. So you're getting back money that you didn't put in. Whereas a lot of times credits are limited to the amount of taxes you actually have. So this is one where you're getting money. If you qualify, you'd be getting money back from the government that you didn't put in. This got a lot of press. Some of it was already scheduled and just wasn't renewed, was allowed to lapse. And the big part of that is we know that these really complex credits for electric cars expired. It wasn't a great big window, but there was a window. Those expired September 30th as they were scheduled when it was first passed. So that's the biggest, we'll call it non-extension. However, the chargers for those vehicles and the energy efficient building improvements, so things you do, windows, doors, those sort of things, lighting, still get credit through the summer of 26, or through June 30, 2026. So that got much press on that. The other big piece that people were concerned about sunsetting, and depending on who you are, this might have been your biggest concern, is the estate exemption. So not that many years ago, and what is the estate exemption? It is the amount of assets that you own when you pass away that the government will not tax. That you get a deduction for those that go to your spouse, but the rest of it is subject to tax. And so not that long ago, it was raised to $5 million in 2000. And then it was adjusted for inflation. And then in 2017, it got bumped up. And had this not been extended, it would have reverted back to about $7 million at the end of 2025. But it is $15 million permanent going forward and then indexed for inflation. So the step up remains, the portability between spouses remains. So this is, in the wealth arena, this is a huge development, because this bill passed in July, and there had already been a huge scramble to update people's estate documents in case it reverted back to $7 million at that point. So this is big. What impact did it have on the states? It had absolutely none. The last bit on the federal side is the annual exclusion is $19,000 for both 25 and 26, not adjusted for inflation. Most states don't have an estate tax, so it's not an issue. Maryland and DC are two that do. Maryland is currently not scheduled to change, nor is it indexed for inflation. And on top of that, Maryland has an inheritance tax, one of only 7 states to do that, which is an additional tax on non-familial beneficiaries. So if you leave your children, no inheritance tax. You leave your good next door neighbor, inheritance tax. DC's exemption was set at 4 million years ago, and has slowly gone up for inflation. And so for those DC decedents in 2025, the exclusions there on the screen, 4.8732. In 2026, going up to almost $5 million, but 4,988,000. So getting close. Virginia repealed theirs back in 2007. Why is it on there? Because there was an effort to reimpose it in 2020, and it was repealed. So just like for income tax matters, for residency matters for estate purposes as well. Mileage rates adjusted annually for prices. The big takeaway on this one is there was concern, well, does this apply to my hybrid? They're not going to break them out versus gas, diesel, hybrid. But so 70 cents a mile. The mileage rate for charitable activity remains at 14 cents a mile, because that's set by statute, and Congress doesn't seem to be in any rush to change that. There's a lot of, as people said, cats and dogs here. In terms of other provisions in the law, from what are called Trump accounts for newborns to limitations on wagering losses. As a non-gambler, I sort of chuckle at this one, because now your losses are only limited to 90% of your gains. So people that used to have enough losses to offset their wagering gains might find some surprises this year. So let's talk about the business side. Again, the big thing here is there's certitude going forward. So a lot of the 2017 Act was made permanent and carried forward. And bonus depreciation is probably the thing that affects by number more businesses than any other provision. And bonus depreciation is where the government says, we're going to let you write off what you place in service 100% this year. 100% if it's in certain things, essentially almost everything other than real estate. And when do they do that? So this has happened in different times. It happened after 9/11. Again, we were trying to get, remember those commercials, let's get America rolling again, get people buying cars and trucks and things. Happened again in 2008, 2010. And then it came as this act. And the idea is to spur investment. If the government's willing to, frankly, make it cheaper for you to put certain assets in service, it's going to spur you to invest. It's going to spur you to build your business. But again, instead of cliff sunsetting, it was already scheduled to sort of stair step down. And as you can see, in 23, it was down to 80%, 60%, 40%. And then you see the little thing, well, it's 100% in 2025. Yay! After January 19th. So you have to look and see if you put anything big in service at the beginning of the year, you want to go back and check your documents on that. But bonus is probably the big business thing to take away from that. Section 179, similar, but not the same as bonus, basically allows you to write off up to a certain dollar amount because there's no limit. There's no dollar limit in bonus. We didn't have a dollar limit. We had a percentage limit. We didn't have a dollar limit. 179 lets you write off up to a certain dollar amount assets placed in service, but you can't create a loss with it. You can with bonus, you can't with 179. So there are some differences there. And that's where the planning comes in, because then, of course, some of the states don't follow those protocols anyway. Another, SALT was the term we heard starting in 2017, although the concept was around for years and years. QBI, qualified business income, was created in 2017, and this was an adjustment to reality. So most businesses are formed as some sort of a pass-through. An S corporation, I guess in terms of familiarity with terms, we would say partnership, sort of all know what that is. S corporation, may be familiar with it. LLC, everything's formed as an LLC these days. And so those are considered pass-throughs in that the entity doesn't pay tax on the income, the owners do. So the partners pay tax on the partnership income. However, if we go back a bunch of slides, we see that the individual rate tops out at 37%, but the corporate rate is a flat 21%. So there's a rate disparity there. So the idea was, again, we don't want to penalize people for the form they do business in. A business should be, conceptually, business should be a business. They should be on a more level playing ground. So the idea was for under this what's considered qualified business income, you'd be able to deduct up to 20% of that income from that income when calculating the taxable income on an individual return. So the idea was to bring a little bit closer parity to the corporate structure. And that's what this is. So this concept continues. It's made permanent. So this isn't one that sunsets. And then there are some certain limits, and some types of income don't get to take advantage of it because they're not considered as productive as others. They're not making things and building things. All right. So for the politics part, no tax on tips. Actually, let me finish up on the PT. So we talked about the SALT limitation, the $10,000. So states came up with these workarounds where basically they said, you know what, the partnership we just talked about in the last slide, it can pay the tax for the partner. So Greg and Richard have a partnership. It makes $100,000. Greg picks up 50, Richard picks up 50. The great state of Maryland's going to tax 8% of that. So what these states said, but I'm probably not going to get the deduction if I've got real estate taxes and other income taxes. So the states came around and said, you know what, we'll let the Greg and Richard partnership pay Maryland that $8,000. Okay. And then Greg and Richard would each get credit for it. But But now, for federal purposes, the Greg and Richard partnership will be considered to have only earned $92,000 because it's going to deduct that $8,000. So it is a classic workaround for these SALT tax limitations. This has been preserved. This doesn't affect your $40,000 limit for SALT tax or the $10,000. But it's a workaround that a lot of the states adopted starting in 2018 and going forward. So that has been made permanent. Politics part, we heard no tax on tips, no tax on overtime. Gets a lot of press. It's a really narrow needle to thread. And really, you still pick up the income, but you get an itemized deduction for it. So it's really a deduction, not an exclusion. The onus is on the employers to track this. W-2s are not going to be updated in time. So literally, it's going to be a memo on your W-2. Confusion will probably reign. Same thing with the no tax on the overtime. Again, a lot of press, pretty narrow needle thread. It's on the overtime. It's on the owners of the business to provide the detail on that. It'll be a memo on the W-2s. Confusion will reign there, and there's literally more analysis and rules coming out on that almost daily on that as to how it's computed and who's available, who's eligible. It's not, if anybody's wondering, can I turn my whole Council Buchanan Mitchell bill to Richard into one tip? You can't. You can't. It's those professions that ordinarily have tipped income. So 1099s. We're all familiar with 1099s in general. You have 1099 DIV for dividends. You get a 1099 INT for interest. You get a 1099 MISC for miscellaneous sources of income. And now you get a 1099K for basically online payment processors, Venmo, Etsy, those things. So they're reporting to the government and you the dollar amount of transactions that you had. There's certain limitations. I mean, there's certain hurdles you have to get over. $20,000 transaction of dollar value, and then 200 transactions. They've been 600 since I was in kindergarten. So if the $600 limit were inflation adjusted, it'd be a lot more than 20,000 at this point. But there will be new forms that some may have started getting last year as well, and you have to pick up that income. Again, there are a lot more provisions that are actually in this, be it charitable contribution deductions from the corporate side as well, business interest limitations and things. So there is more to that. So what are we supposed to do before the end of the year? Let's talk about a couple things. The Secure Act, which is unrelated to all this, which was designed to basically make retirement accounts more portable, more flexible. Another part of it kicked in 2025 with a new special catch-up for those of us in the age 60 to 63 window. And this is a classic example of, when it benefits you, it's a planning opportunity. When it benefits somebody else, it's a loophole. But this is basically the government letting you put in that window there, because the analysis showed if people get closer and closer to retirement, they might not have enough money in there. The IRA contributions, $7,000 for a long time. It will adjust in 26 because of the inflation adjustments on there. For a Roth, the income limitations follow the same, but there is an opportunity in certain individuals to convert a traditional retirement account to a Roth. And basically, when you do that, you pay taxes in the year you convert it, but then it grows tax-free and can be distributed tax-free. So again, as a classic planning opportunity there. That is a great planning opportunity. And it could be you have a down year income-wise, so you can convert it at a lower rate. It could be you didn't manage it well and it's down in value, so you want to convert it when it's low in value for that. So those are some retirement opportunities that are coming up there. So many things have tax consequences that we often don't think about it until it's too late. Changing jobs, having children, retirement planning, exercising stock options, receiving a promotion with a nice raise, opting into an employer-provided retirement plan, like a 401k, transitioning parents into long-term care. There's a lot there. there's a lot there, and this is the time of year. It's never a bad time to look at it, but certainly as year end comes, there's complexity in everything, and sometimes it's as simple as the form that you're doing business, like we talked about the QBI before. So in the last 21 days of the year, what do we want to do? Good time to adjust your withholding if necessary, and avoid unwanted surprises and unwanted penalties for not paying enough through the year. But a little quirk about withholding is no matter when in the year it's withheld, it's treated as if it was paid in 12 months during the year. So for whatever reason, let's say I've had no withholding for the year, I have $12,000 withheld in December for federal purposes, it's treated as if it was paid in equally during the year. So we can help you calculate your taxable income, your income tax liability for the year, determine if adjustments are needed, withholding, estimated payments. But the one number to keep in mind, the penalty on underpayments for the fourth quarter this year and the first quarter next year is 7%. So that's not money we're getting back. And on the corporate side, it's 9%. So those things matter. But short version is we're holistic in our planning. We look at the entity and the stakeholders. We look at the business and the family members and the key employees, and we look at it as one economic entity. And why do you do that? Because it's pretty easy to extreme example, pay no corporate taxes because you're going to pay salary out to everybody. You get the whole deduction. As a whole, maybe that's not a great situation. So we approach it from the idea of one economic entity made up of various members. And so that's how we look at being efficient for the family, the organization as a group. We know your time is valuable and coordination is paramount. We touched on a lot today, but everyone's facts are different for that. So we do have a couple minutes left here. We want to go through some questions that have come in. You can throw them in the chat. We had some that came in ahead of time. Where do you want to lead off with, Greg?
Sure. So I did want to kind of dovetail on one of your comments about Roth conversions, just like on the off chance that you happen to be of RMD age, or required minimum distribution in your IRA, you have to take that before you can do a conversion. So just, for people that do some kind of estate planning where you're trying to convert some of your IRA to a Roth, you gotta Uncle Sam wants his cut first, so he wants you to do your required minimum distribution first. But yeah, as far as questions that were submitted in advance, I guess we had a couple on tariffs, and one was about do you expect to see tariffs becoming a major concern in 2026, and then kind of a little bit different topic on impacts on the real estate market. So I would expect tariffs are already a major concern in 2025. And the direction that appears that they're going is in a more positive direction, which is to say, seeing them recede or potentially be, in some cases, invalidated. And I don't know what happens if the Supreme Court rules that the administration could not take the steps it did as far as getting that money back to the companies that paid it out. That sounds a bit like a mess. I know that I don't think I'm going to be getting a refund for anything that I paid for at the store as far as tariffs go, but someone's owed some money. I would think, yeah, it's already a major concern. I don't see it going up from here, but again, I guess anything's possible. And as far as tariff impact on real estate, well, tariffs have an impact everywhere. Real estate in some respects is a little bit insulated from that because it's, property in the US, which isn't really coming from somewhere else. So there's not a tariff on that. I mean, there's tariffs on the items that you might, need for maintenance and upkeep. But, as far as a direct impact on the real estate market, not as much. I would say that that's more of an insulated area. Richard, on the tax side, Did anything in particular jump out at you? I believe you kind of covered a lot of the issues that Maryland residents might see as far as the taxes on capital
Mhm.
gains and estate tax exemption.
I'll just double back on this. So the Maryland estate tax exemption is set at $5 million. I'll defer to people more involved in Maryland politics. I don't see it going up. I don't see it going up. That's for sure. I don't think there's been a proposal to repeal it. There was in the last session, but it didn't get out of committee. And then as far as the new capital gains, it's 2% on Maryland income over 350. And there's very few exceptions aside from the sale of your principal residence. I mean, there's stuff for livestock and things like that, but it's again, that's retroactive to January 1. So that might be one that we've not planned on. The collective we is not planned on in a lot of cases. But that again, that's on top of your regular Maryland tax.
Very good. We have a pre-submitted question about the likelihood of a significant pullback, and then we've got a chat question about the potential of a 2026 bear market. So uh, I would just say this, we kind of covered this in the slide on the long-term, returns in the equity market, and the average pullback was about 14%. A bear market technically is a 20% pullback, which isn't much more than 14%. So you should expect at some level some kind of pullback during the year. How do you protect yourself? Well, you probably want to look in your portfolio and see how expensive are my holdings. And what I mean by that is if things have gone up, what's the most expensive stuff in my portfolio and how exposed am I to that? So, tech growth has been gotten very expensive. And what I mean by expensive is price to earnings. How many dollars are you willing to pay for a dollar of next year's earnings? That floats around depending on the price of the stock. So when you hit periods of volatility, those more expensive things tend to be the thing that sells off first. So, just look at your exposure. I would certainly not advocate making huge changes in your portfolio because now you're starting to get into market timing. And if you've got a set sleeve in your portfolio that's long-term exposure, you really don't want to be involved in trying to time the market, but just understand where your exposure is on your equities and make sure that you're not imbalanced, if you will, with maybe too much growth exposure or too much expensive stock exposure in your portfolio. Um, Richard, let's see.
Actually, can I
I mean,
jump on that for
yeah,
the
absolutely.
charitable part? So one of
Yep.
there's always questions about do I give cash or stock to charities? If you have appreciated stocks, significantly appreciated securities, it is more tax efficient to donate those securities to the charity rather than rather than writing a check. And why is that? I mean, let's say you Greg's done great work for you. Your $1,000 investment is now worth $10,000. You sell that. He's like, well, I'll sell it and give the cash. You sell that, you're going to pay a capital gains tax on that difference. Okay. Whereas if you give that your alma mater, your hospital, all the people that reach out to you, you get the charitable contribution deduction for the full $10,000. So you have avoided that capital gains tax. Now both federal and Maryland, if you're a Maryland resident on that. So in terms of efficient gifting, in terms of efficient charitable contributions, that's only to get that in with looking at stocks that may be at higher risk as they're more expensive. So go ahead.
That's an excellent point. Rather than, selling and rebalancing, consider looking at some of those areas for getting some tax benefits there. And we would certainly think that that's a pretty good use of pretty efficient, tax efficient use of your charitable donations. Um, yeah, and someone just asked, can you give those higher equities to a DAF? Yeah. Yes, And that's a great idea. Use the DAF because like Richard, you were saying this earlier, you want to get those bigger charitable contributions in this year. So if you're planning, if you have a bunching strategy or something like that, this is the year to do it.
Yeah, absolutely. Actually can't stress that enough. If you need one takeaway, if you're thinking of doing significant charitable contributions in the next 13 months, I would look hard, depending on your fact situation, I would look hard at doing it this year if you can. Because let's say you overestimate, you give too much, that excess still carries over for 5 years. So you're not going to lose it.
Yeah. Yep. Well, I mean, we are at just after 12 o'clock. And we're kind of at the end of the question. Someone did ask about what's a DAF, and yes, it's a donor advised fund. It's kind of like a way to give directly to a charity and then distribute out to the charities as you see fit, but getting that tax benefit all in one swoop by giving it to the kind of the charitable shell of the donor advised fund.
Yeah.
Well, Richard, do you have any other closing thoughts?
No, thank you guys for giving the time today. You will get a copy of the slide deck for all those who signed up as participants. Appreciate everything, and if nothing else, happy holidays, everybody, and let's hope for a great new year.
Happy holidays, everyone.